Today is edition of Back Roads of Illinois. We were bringing you lasted for farming sources and information sponsored by AgriGold. This is the Markets Club podcast. I'm going to have a conversation about the livestock markets with Don close from terrain. This week is Beef Week on Back Roads of Illinois. We were talking about the cattle markets with Scott Verilek from Kooima Evielk Trading. We were talking about the commodities markets with arlan Sudermmann from Stonex. Here's Don close from terrain. I'm going to have a conversation about the livestock markets with Don close from terrain. Hey, Don, how was your trip in San Antonio?
It was a good trip. It's always good to see everybody. It was really a non-eventful convention. The high prices cover up a lot of issues, but with the market as good as it is, everybody was really happy. A lot of uneasiness just on the high price of replacement cattle, the level of risk involved with ownership. Will consumer demand hold with these retail prices? So they've got a lot of worry, but overall attitudes were really good.
Great to hear that, but the heat, we talked about it off there.
So the weather was it was just miserable. It was incredibly humid, and temperatures during the day would get up high 80s, low 90s, and it running around with a sports coat on all week. It was just the weather was miserable.
Of course. Let's discuss about these cattle trend for right now. What is your thoughts on this prices?
I still like the market for the long haul. I think if you look at where we came out of the cattle inventory report, there's still seeing a net contraction across the board. If you look at the cattle on feed numbers and what we'll likely see on feed for the remainder of the year, supply side, the market still is incredibly tight and going to get tighter. On the demand side, we're for the last year or two with the contraction of supplies, we have been working on tracking demand the best we can, and with all the work that we're doing, we haven't seen any softness in consumer demand at this point in time. In fact, if we drill down into that demand data, we're still seeing demand growth for the prime product. We're still seeing demand growth for the upper two-thirds of choice. We're still seeing demand increase for the whole lineup of ground beef products. And so our view of the market is there's still volatility is going to be a huge factor from here going forward. But on net price gains, even with the record prices we've recently seen, we think there's more record prices to come before this rally's over with.
What's impact for the long term with the prices? Dawn. What's impact on the prices for the long term?
So clearly, we're looking probably, we are not expecting any expansion in 25. If we had to, while mathematically it could be possible, but not likely. So we're expecting an additional slight decline in total inventory in January 26. Think we'll start to see some retention and herd rebuilding through 26 and actually be into 2027 before we see any opportunity for net increase in beef supplies. If you look at the tight supplies of females collectively, our cap on just how many additional cows we can liquidate to supply the ground beef market, and then the distribution of heifers with the other heifers category still, all of them smaller, but more heifers going to the feed yard. We can't help but think that in order to get this market into an expansionary phase and the additional contraction on beef supply that retention of heifers will drive, the only way we see our way to the end of this market is that ultimately retail prices will go higher than what anybody's talking today. So I think the price shock to consumers is still ahead of us.
Yeah, we'll see for next couple years for the cattle expansion. We need meat.
Yes. Yes.
What is the numbers in the feed report from January?
So the big surprise with the cattle on feed report was that placements were below trade estimates at 97%, on feed at 99%, and the marketing number was good at 101. Now there was an additional day in there that helped boost that marketing number, but across the board, particularly with that placement number below trade expectations, it had a bullish connotation to it. The big impact there, you had a 27% decline in placements in Texas. That was the reaction or the response to the border closure because of the screwworm situation. So that was really the driver that forced those placements lower. But at the same time, Nebraska was lower. It I don't know to say it was outright. It was very positive. I don't know that I want to say bullish, but it was very positive.
Can you tell us what's with the numbers for packers in the South compared to the North?
We've actually been seeing, and if you look at the price discrepancy that we saw through November and December, and well, I guess December, January. But if you look at the premium that cattle were bringing in the North Plains opposed to the South Plains, we've actually seen tighter supplies of cattle in the North than we have the South up to this point in time. I think the tighter supplies to the South are still to come.
Finally, what is your thoughts on the nooser worm?
As you're well aware, we have been able to reopen the border at the primary crossing point. Specifically to that is the big one at Santa Teresa. From what I've heard or not heard, I think the new quarantine and inspection procedures are actually going quite well. The first of the reopening cattle started crossing the border, I think, last Wednesday. So that's better. I I really think that the isolated case that was found was far enough south. Uh, the intervention procedures that have been made with the additional inspections, and certainly the big one with the escalation in the release of sterile flies to try to get a limit on the spread of the screwworm flies. But I I think this one will be uh, corrected and worked into the market quite quickly. And I do, because of the time of year, I don't think we've really got a serious backlog of cattle in Mexico that we're waiting to come over when the border reopened. So I think that will be worked in relatively uneventful. My biggest concern is if we go, 4 to 6 months, we have another outbreak that's further north in Mexico. If we have additional outbreaks, it's going to be way more complicated than where were with this case. So, yeah, it's a disruption. Yes, it's going to require continuous monitoring, but I don't see any and the correction that we've seen specifically in feeder cattle futures from that announcement. Clearly, the market is removing that risk premium out. So I think we'll get along, move forward quite readily without the event of any other outbreaks.
Do you have any concerns about biosecurity in the herd like bird flu? Dawn, we seeing it in dairy.
Yes. And the fact that the announcement last week of a new variety of bird flu in dairy cows in Nevada, the fact that you've already reported human cases, I'd say as far as potential market disruption, the whole bird flu expansion is, in my view, and this, we're out of my field of expertise now, but I'd say the ongoing issues with high path avian influenza is a way bigger threat to the market than what the screwworm is, at least at this point in time. If you expand the high path question, the destruction of the number of layer hens, where we're seeing the limited supplies of eggs and price of eggs at the retail counter. That one is going to be ongoing and a bigger concern.
Yeah, of course. This is your commodities markets for this afternoon, sponsored by Kyle Bumstead from Allendale Incorporated. Corn futures is up for today, but the soybean futures is down for today. Corn futures is up at 5 to 10 cents at the half. Soybean futures is down at 3 to 5 quarter. Chicago wheat is down at 3 to 5 cents. How is the livestock markets for today, Dash? Cattle is up at 5 to 4 cents. Feeder cattle is up at 3 to 6 cents. Lean. We'll talk about the commodities markets, especially in the technical fundamental on the grains and livestock as well. What's impact on the quarter for right now? I am joining with Arlan Sudermmann from Stonex.
Hello, Cesar. It's really great to be with you again today.
I'm happy to have you again. Let's discuss about these grains for right now. Could you tell us what is going to get passed on these markets? Arlan.
Well, we just finished with the USDA report on Tuesday, and it was a relatively routine, boring report, as February reports often are. I think the market was disappointed. We had seen quite a rally in the grain and oilseed markets in recent weeks. And so the funds were hoping to see some further reductions in U.S. grain and oilseed stocks to justify the move that they've had. They did not get that. We did not see an increase in corn exports or an upward adjustment in soybean exports or anything to tighten up the supply here in the United States, even though USDA made some significant cuts to South American production for corn and soybeans. And that disappointed the market. A bull needs to be fed every day, and USDA didn't feed it. So we saw some fund managers take some profits. But as we rolled into Wednesday's price action, I thought it was very significant what the follow through was like. They continued to sell soybeans on the rising global supply of soybeans, despite some problems in Argentina. We saw corn prices going back higher. The funds seem to want to defend their positions, their ownership of corn. They hold near record large, not record, but near record large positions in the corn market. And they seem to want to defend that for the long haul right now, believing that global exporter supplies are tight. And so if there is a weather problem, an additional weather problem in Argentina later in the growing season, or in Brazil as they grow their winter corn crop or safrinha corn crop, or in the U.S. Midwest this summer, they will have ownership in place if prices were to rise. Wheat tried to follow corn higher, just simply didn't have the conviction in wheat yet. We think those wheat fundamentals are going to strengthen as we get into the fourth quarter of this year and into the first quarter of the next marketing year.
How is the world stock from yesterday? Arlan.
Well, world corn, soybean, and wheat stocks all declined, largely because of decreased production of corn and soybeans in Argentina, as well as decreases in corn production in Brazil. Now, the interesting thing is the decrease in production from Brazil had to do with the winter corn crop, which makes up more than 3/4 of Brazil's corn production, and that's where their exportable supplies come from. Excuse me. And they reduced the corn crop size there while the crop was still mostly in the seed bag yet. And they did so because planting is delayed by about 10 days or so. That seemed a little bit unusual to me that they'd be so quick to cut production simply because of about a 10-day delay in planting. It does increase risk some, but it doesn't guarantee that we're going to see a short crop in Brazil. We also saw China imports of corn reduced by about 3 million metric tons, and Chinese imports of wheat reduced by about 2.5 million metric tons. USDA also cut Russian exports as well as Ukraine wheat exports, each by 500,000 metric tons.
Of course. Arlan, how concerned about demand flows to China?
Well, I think when it comes to China, you have to always be concerned about the relationship, and there's been a lot of concerns with the coming trade war with China or fears of a trade war with China. During Trump 1.0, it took several years to get a trade agreement with China. I think it'll take months this time instead of years, but I do expect an agreement. I think President Xi Jinping of China is in a weaker position this time around with the weakness of his economy. And so I think that there is some incentive, and we're actually hearing chatter about this on the ground in China, some incentive for them to agree to revise the phase one trade agreement from the first Trump administration, where they would commit to buying U.S. commodities, even though they're more expensive because of our strong dollar, in order to get more favorable tariff treatment on the $450 billion worth of consumer goods that it ships to the United States. But it is going to take time. And so I think there's going to be frustration. The strong dollar is actually a bigger threat right now to our exports than are the tariffs, because as long as South America has the supplies, they're going to be buying from them rather than us, simply because it's a lot cheaper to do so. For example, Brazilian soybeans right now are $1 per bushel cheaper delivered to China than U.S. soybeans from the Gulf ports.
It's a fundamental standpoint.
We continue to see very tight protein supplies in the United States. That's because of the shrinking cow herd due to the multi-year drought in the western part of the United States that eventually resulted in fewer cattle going to the feedlots and fewer cattle being therefore harvested for meat. We've also seen bird flu reduce our laying hen population by about 8%. So trying to repopulate that is taking time. The cow herd, we are seeing some very, very early signs of rebuilding. But once we really genuinely start to rebuild the breeding herd, that's going to further tighten up to our supplies as we hold back heifers. That has taken prices to record levels, but surprisingly, the consumer continues to pay up. We have been raising cattle to record carcass weights because feed has been relatively cheap. And between the record carcass weights and massive imports of meat, we've been able to fill the demand of the U.S. consumer. But I think the most impressive feature is the fact that beef prices have gone up over the past year, but yet demand for it has also gone up because the consumer confidence is high and has been finding the money to spend.
I have a lot of stuff on the cattle markets. Maybe next time we can talk about it.
Excellent, Cesar. I've really enjoyed being with you today, and I hope you continue to have a wonderful week.
Do you have any final thoughts on the world supply for this week?
Well, I think the world supply overall of corn and of wheat among the major exporters continues to shrink and is relatively snug, not necessarily tight enough to justify rationing demand with higher prices, but leaving us vulnerable to that need to ration with higher prices should a major weather problem develop. The keys to watch are going to be the growing season in Brazil for their winter corn crop, the U.S. Midwest, which has some elevated risks this year for drought during the summertime, and also the Russian wheat crop. And if you look at combined exporter supplies as a percent of use for corn, global corn, they're at long-time generational lows. And so, as I said, that does leave us vulnerable should a major weather problem develop someplace. Soybean supplies, global soybeans, on the other hand, are increasing and may reach record high levels this year.
How about the planting intention report on March? Arlan.
Planting intention report in March, I think, is going to be very pivotal to see how much U.S. farmers plan on increasing their corn acres for this next year. The market is obviously trying to incentivize farmers to plant more corn this year. The core of the Midwest, our primary production states, for the last 15 years have really not wanted to change their regular soybean rotations. And so most of the change from year to year in our acreage of corn and soybeans has come from the fringe areas of the core of the Midwest, like the South and the Plains. But this year, we are hearing about significantly higher corn seed sales in the core of the Midwest and much lower soybean sales. So there is some sense that we might be looking at a significant shift away from soybeans to corn. So I think the key is, can we sustain the current attitude of fund ownership in the corn market past that planting intentions report? That'll be a risk to the market. I've heard anecdotal stories of big seed sales before that really didn't play out. Will they this time? I don't know. We're continuing to collect data on that. But if there's a bearish surprise on the acreage shifting to corn on March 31, that could leave this corn market vulnerable.
Yeah, it is pretty important for our food system for this report.
Absolutely.
Thanks, Arlan.
Thank you, Cesar.
Arlan Sudermmann from Stonex on back roads of Illinois. This week is Beef Week on back roads of Illinois. We were talking about the cattle markets with Scott Verilek from Kooima Evielk Trading. Otherwise, how are you? And did you went to the cattle con in San Antonio? Can you hear me? Scott, how is the reflection on the markets with these cattle trend for right now? This week is Beef Week on back roads of Illinois. We were talking about the cattle markets with Scott Verilek from Kooima Evielk Trading. Otherwise, how are you? And did you went to the cattle con in San Antonio?
Yeah, I'm doing well. I didn't get to go to San Antonio. Brad Kooima, my partner, he always gets to go. So I guess I drew the short straw and had to stay home, but sounded like there wasn't, any major issues. It's amazing when you have record high prices, and we're all doing good and we're profitable that we don't have near as much to complain about. So I guess it was probably a fun time down there.
Not fair, Scott.
I know. And one of these years I'll get down there. I'll get to go, but it might be a few years yet.
Yeah. Scott, how is the reflection on the markets with these cattle trend for right now?
The trend is, has been such a nice, strong uptrend line, and we still have, support on some of these long-term charts. But short-term, we've been a little bit more on the shaky side, and a pretty swift correction here. Maybe a few different reasons why. One, we've got the Mexican border opening, and Two, we've got the new strain of bird flu they talked about. That was probably, talked about for one day. I don't know if that's the major factor here, so I'm not so worried about that one. And then you've got Packer kill cuts. I just think the cash market has gotten away from the Packer here, so it's what they're trying to do to try to rein it back in. So um, it's affecting us a little bit now as we see some of this lower cash trade slipping down to that 203 mark, but I think they're going to need some, excuse me, I think they're going to need some cattle yet because right around the corner is spring demand and when they're going to have to buy for it. So I'm feeling okay yet, even though we've been a little bit on the negative side, but it's challenging to say the least here.
How is the cash trend for right now with the feeder markets?
Feeder market has been the true leader to this market and really seeing levels we've never seen before. And I was always getting messages on how high this group sold or this one. So I mean, it's setting some pretty high bars, and we've got tight numbers. We know that we do, and it's evident on the prices. Now with this last little break, we're seeing some softening, maybe slightly, not a large amount lower, but maybe a few radars going off saying, okay, we're not just going straight up anymore. So maybe a little bit more hesitation. But for me, we're starting to see some of these heifers try to go back to the cow herd, and that means less of them to go to the feed yard, which is going to cause prices to stay high for a while. And also hearing Texas is holding quite a few back for heifers. So if we get some moisture across the south, we could see some of that rebuild. But what that does is that just puts a nice floor underneath this feeder market. And I'm optimistic. I think it's got a pretty firm floor on it. This supply is not going to get built overnight. And we know how long it takes to hold a heifer back, get her bred, have a calf, and then have that calf get to market and become finished. I mean, it's a couple year period. So these tight numbers are going to be around us for a while. And I think that's going to keep showing up in the sale bars here.
What happens if the expansion is going on with these prices?
Yeah, that's the thing. When you take some of them out of the feed yard when we're already kind of tripping over ourselves to find feeders, when there's less of them to choose from, I think that can mean, hey, if there's 3% less in the sale barns because they're going back to the cow herd, I think that could create some more bidding wars to happen because there's plenty of guys that have been having to sit on their hands and start slow. So I think that there's some room in the feed yards for cattle, guys that are still looking for them. And we're sitting here in the middle of February when some of these large northern runs start to slow down. Excuse me. And a lot of them will have to turn towards southern cattle as we get better weather and that they can handle some of the conditions. So it's going to be interesting going forward. We do have a Mexican border that's open, so that could, aid in, some of the placements in some areas that need more cattle. So short term, I think that we're still going to see some decent prices going into spring, and not rebuilding the cow herd fast enough. So I think that, hey, even in next fall, I'm still feeling okay. And like we've got a pretty firm floor. Could we use a correction from these record highs? Yes, it could happen at any time, but I still feel pretty solid about our long term going forward here.
Of course. Do you have any concerns about these prices in the feeder for right now? Could you explain what is your position on the cattle markets?
There's plenty of concern just with the amount of dollars that we're handling with these calves, and that makes you pretty nervous. I mean, it's a very humbling market where you put your money where your mouth is, and it's going to move up or down. It's going to be volatile. So for me, I'm trying to think that we still have some long-term hope, and they're still going to need an individual cow-calf guy around to make these calves. I mean, that's the corner that we got painted into. Not enough dollars were making it down to the cow-calf producer, and I think that that's going to have to be. That's the last of the real independents left in this cattle industry because you've got packers and you've got large corporate feeders. But the cow-calf man has not been that consolidated yet. So my optimism lies there that I still want to be in the raising the calves business. That's my natural, what I grew up with. So it's what I love. But the amount of dollars, yeah, you can be friendly, you can be bullish, but I do think that it'd be ignorant if I just didn't have any protection because I thought it was going higher. There's just too many dollars at risk. So trying to find a way to lay some of that off, but still have some upside. It's a challenge. We have to get used to paying more for puts than we used to. Hey, it's because we're insuring a mansion and not a trailer house. I mean that's how high these prices are. So it's going to cost us more to do that, just that, insuring those cattle.
Okay. How long will be with these cattle trend for right now, Scott?
Yeah, the trend right now, I mean, I'm feeling like, with this last break, we're all trying to grab for nuggets on what the charts look like. Are the funds gonna wiggle? And the funds have wiggled a little bit, got out of some of their positions here, but we still have some long-term uptrends that are holding. And I think that the spring demand is coming. I still think that the Packers are going to want some cattle, and we know this demand is outstanding, and it has been. So if they try to start to fill the shelves for some of this good grilling season movement, I feel like we've got a little bit left in the tank for another charge higher because we're feeling pretty current. We've been getting cattle sold right along. Weights are still up. That's been aiding in some of the lower numbers. Packers have been able to use that. When we're selling over $2 fat cattle and your cost of gains are around $1, you're going to put the weight on them. So we are doing that. Starting to see a little winter now. We'll see if that gets to be a little bit more challenging. If winter stays on here for a little while, it's not going to be as easy to put some of those extra pounds on. But I'm anticipating our seasonal cash highs middle of March can still, at least we trend back to some of those prices that we were. I think there's a pretty good chance for it.
Yeah, I saw the weight for this weekend 324-310.
Yeah, we've got, just a little bit shaking loose. There was a little bit of 203 live trade, and I heard of some 320 in the meat did happen. So yeah, those prices are good. I mean, we were standing on top of our desk cheering when we first got to 203. So it's still not a wreck, but I did hear, I think there's still some packers looking for some cattle here in the short term, and we might still see a little more action this week. It's still midweek, and we've got a chance to rally this just yet.
We know that this time is good for a cattle producer. What is the risk for the livestock markets?
It's your seasonal cash highs fall in March. April's usually your really fun time to try to sell cattle, April and May, and still think that's there. As long as, economy holds together, which seems to be doing great. We've got a consumer with a high taste for beef, especially as we get into the spring time frame. So I still feel good enough about the spring yet. The only problem is we just haven't been a seasonal kind of market just as high as we are. So that's your risk. I mean, as high as we are at these $200 prices, we could still break this market a ways and still be at a high price. So some of those seasonals I've had to kind of ignore them a little bit, but regardless, I think the tight numbers can still show up. We've still got some leverage, and we should be able to use it.
Do you offer LRP for your producer in your firm?
We do offer some LRP. We had done, quite a bit of that the last few years, and I feel like right now it's been a little tougher to do, just because the dates don't line up, and this basis has been so outstanding on cash over what the futures are and over what some of these prices are. So there's that, but but just the pure movement of the market. You're down $2 or you're up $2 or more or $3, the big moves. So when I sell my cattle, I need to be able to get out of my protection is what's making me a little nervous. If I sell them 3 weeks ahead of my LRP date, I can't get out of it. I'm locked in that position. Or if that goes off and I have another week to go. So I've been steering more towards puts. I think I've bought more just straight puts this year than I ever have. And as an office, that's kind of how we feel, but we still offer it. Some guys really like it, and then that's understandable. But I feel like I've had to steer away from it just for a little bit at the moment here.
Do you have any final thoughts on this cattle markets for right now?
I think the biggest thing that I kind of said was it's a humbling market. You can I could really feel like I'm right. That's an old saying. You might be right, but you might go broke trying to be right. And there's just that much risk at some of these levels that I can't just ignore it. Even though I'm friendly, I still think numbers are tight. Feeder calf prices are going to be good. We still have to look at our own bottom lines and decide, what can I handle? If this market breaks $10, $20, what kind of trouble am I going to be in? So I'm just trying to make sure that doesn't happen. I love this business and I want to make sure that I'm still doing this business tomorrow.
Thanks, Scott.
Yeah,
This
thanks for
is
having me,
Scott
Cesar.
Verilek from Kooima Evielk Trading on Back Roads of Illinois.
Thanks for having me, Cesar.
Thanks to Don Close from Terrain and Arlan Sudermmann from Stonex. Scott Verilek from Kooima Evielk Trading. This has been the Markets Club podcast. I'm Cesar Delgado.